Hello everyone, have a pleasant stay. This is Dr. Srimati from Dr. Ambedkar Global Law Institute, Tirupati. Today we are going to see the financial services, banking and insurance. In that subject, we are going to see insurance. Introduction. Every element of society is exposed to some kind of risks. So, you know what kind of risk is like a fire, accidents, floods, war, and many other hazards. So, here, human life, every human life, as well as the property, are also subjected to the many kinds of risk and uncertainties. So, one suppose an human being, if he falls sick or becoming old, and his or her death may leave his dependents deserted and helpless. That time, what to do when he has sudden death because of an accident? So here, as well as in case of a business, the property of the business may be damaged or destroyed by fire or any other accidents also. Then what to do? So thus, the risk of all kinds involves losses of various types. So let's see the meaning of insurance. So the insurance means of protection against the risk of loss. So this is about the main aim. It is about the protection against the risk of law. So it's a means of shifting the risk to insurers. That is, everyone wants to shift their risk to others. Likewise, here also the risk is shifted to insurer. So what for the insurer will take the risk means with some consideration. The consideration is a nominal cost which is called a premium. So the insurance aims at spreading the risk and compensates the person which has been affected by any fire, accident, something like. And the compensation is paid out of fund which has been created by collecting the prescribed amount of contribution from different persons who wants to get the uh, share the risk, and thus we can say the loss is distributed among the large number of persons, and when the loss is suffered by few and which are being borne by many. So we could come and conclusion that the insurance is based on an important technique that is called a pooling system. Otherwise, we call that economic cooperation by different persons. And the definition, you want to know the definition, right? So as per the American Risk and Insurance Association, the insurance is pooling of forfeit losses by transferring such risk to insurers who agree to indemnify insured for such losses to provide other pecuniary benefits. Pecuniary benefits if the person is not affected or if the person has not suffered with any of such risk, then he will receive the benefits. That is pecuniary benefits on their occurrence or to render services which has been connected with the risk. So this is about a definition. You can write definition as such. And the general principles of insurance. Suppose if you want to enter into a contract of insurance, then it should have certain basic or fundamental principles. And these principles are the principle of indemnity, a principle of insurable interest, principle of utmost good faith, and principle of subrogation, and principle SEMA, and the principle of contribution and principle of mitigation of loss. So these are the main principles under which the general conduct of insurance are entered. And different kinds of insurance available now, and so this insurance has become an integral part of business as well as human life. Any business or any human being if you take, then they have to get insured, and it is an indigenous and wonderful device which has been invented by man to guard against the risk and facilitates the smooth functioning of economic system and its kinds. So economic system, that is, the insurance has become integral part of a business as well as human life, we said. So every business, whether it is about a big or small, and human life, whether he is about a star or whoever it is, a normal common man, whoever it is, they want to get their insure life. And it is about an why we want, means we want to safeguard the risk, and we want to functions with a good economic system. So there is about different kinds of insurance available at present. The first one is life insurance, second one is fire insurance, and third one is marine insurance. We are going to see all this in the future videos. And before seeing this kinds of insurance, we want to know the insurance sector's reform in India, how it has been reformed in India. That is, say for example, that is the Insurance Act on 1938, which was been administered by the Controller of Insurance, which has been meant to regulate the insurers before the nationalization of life and general insurance. So the day of nationalization, the nationalization of the insurance company greatly modified the application of the act. So now we have the regulatory functions which has came to vested with the life insurance and general insurance corporations. So why it has been done means with the consequent to the recommendations of Malhotra committee in the year 1993, which has been appointed by the RBI to suggest the measures to improve the efficiency of insurance service sectors in India. So they have given the suggestions. Based on the suggestions only, made it Insurance Regulatory Authority, that is IRA, and was constituted in the year 1996. So the IRDA Act, the present Act, IRDA Act has having the following powers over the working of insurance companies, both in the public as well as in private sectors. Let us see the powers. So first one is orderly growth. They want how they have the power to do certain functions, no? So in that first one is orderly growth. This IRDA is regulating, promoting, and ensuring the orderly growth of insurance business. And the second one is exercise of powers, and exercising all the powers and performing all functions of controller of insurance under the Insurance Act 1938. So the LIC Act 1956 and the General Insurance Act 1972. All these three acts they are exercising. And protecting the policyholders. This is about a main. You can easily see the number of advertisements. This is for the protecting of policyholders only. So protecting the interest of policyholders in the matters concerning the assignment by the policyholders are insurable interest or settlement of insurance claims, the surrender value of policies, as well as any other terms and conditions of contract of insurance that could be protected by the IRDA. And the books maintenance is so which has been prescribed in that Insurance Act. The same way it should be. Suppose life insurance means which has been given under the Life Insurance Act 1956. Suppose general insurance means General Insurance Act 1972. And the next one is adjudication, adjudicating the disputes between insurers and the intermediaries. So they want to give adjudication. Suppose is there any disputes then between the insurers and the intermediaries. And the next one is investment. So the fund which has been collected as a premium must be invested by the business, insurance business. So how the investment is. So the regulating the investment of funds by insurance companies, and the regulation of maintenance of margin of solvency. So every insurance company, they have to maintain the solvency ratio. And we are concluding that this IRDA acts ends and monopoly of government in the insurance sectors, since before that it is about a government sectors only. You come to know there is LIC and general insurance corporations. Now you come to know there are about mushroom growth in the private sector of insurance, and because it seeks to promote the private sectors in the insurance, and then it gives priority in the utilization of policyholders funds for the development of social as well as infrastructure sectors. And then the government has given license to number of private sector companies to do insurance business. So likewise we are going to see future videos related to insurance one. Thank you, which will be continued in the next video.